Now, on to today's market movers with options and futures trades from CME Group.
Welcome to Market Movers. I'm Jim Muriel with Scott Martin.
Hi, Jim.
Okay, so about a year ago, the correlation, the inverse correlation between gold and the dollar, which has historically been fairly true, seemed to break down. Why?
Jim, you always ask the hard questions.
This is not easy, yeah.
I'll tell you what's interesting to me is that it's the safe haven trade in the sense of I do believe that there was a lot of tumult, let's say, in the market, a lot of uncertainty, whether it was recessionary, Fed, politically, and that's why I believe the dollar and gold both kind of served as that safe haven. Therefore, they both rallied this year.
Right, and the rates too. Rates went lower too, and gold.
Right, so bonds throw that in as well.
So throw that on. So I like that a lot. Now, is gold still a safe haven? You mentioned safe haven, but you know it hasn't always been the greatest safe haven.
That's what makes gold so tough right here, I believe, Jim, is that sometimes it's been the safe haven, sometimes you've seen that great correlation value, and to your point, of late, it really hasn't stepped up at all.
Sometimes it trades as risk on.
That's right.
Yeah. Now, before we dive into our trade discussion, I'd like to point out that these are examples, not recommendations or advice. When we priced this up, the February gold contract was trading about $14.77. Scott.
Yeah, something you really interestingly said there, Jim. Sometimes it trades risk on, which makes the positioning in GC tough sometimes, which I would add to that, looking at the chart in GC looks tough right now. So I'm trying to find some neat expressions out there that just might be able to express ourselves in a way where if nothing happens or maybe one other thing happens, we can take advantage of it, okay? So specifically, Jim, today looking at buying a week one DEES 1450, 1425 put spread in GC for 2.2 ticks. As you know, Jim, I'm inherently cheap. Therefore, I don't want to pay for this. So I'm going to actually sell a call in GC at 1525, same expiry, for 2.2 ticks. So therefore, I net zero on the buying of the put spread. The reward, though, is 2,500. The risk is being short gold, my friend, at 1525. It expires D6th, so I've got some time to kind of watch this thing, manage it. If I have to take something off, roll it up, etc. Long-windedly, it's just takes advantage of the fact that gold may not go anywhere for a little while.
I do these kind of things, and you do these kind of things too. I just would underscore what the risk is. The risk is being short at $15.25. That's $50 above where the market is right now, so it's a good way away. But if gold ever really does start trading like a risk off and a safe haven, it could be bad to be short there. But as long as you understand that risk, you know, we take risks on occasion, so I don't mind it. I'd mind the direction of it. I'm going to tell you the right direction.
Oh,
just kidding.
Thanks.
Right. So as an example,
Please.
I'm buying the DEES week one gold, the 1485, 1495 call spread for 3 ticks. It also goes off December 6th. And it risks $300 to make potential $700. My point is this, is that rates around the world are negative. Our rates are not, and our rates have seemed like they're in a range.
At times.
But I mean, it just seems like the progression eventually goes for lower rates. I'm not saying our rates will ever get negative, and if that happens, I'm not saying it happens in the next couple of weeks either, but the notion could come up.
It could, and listen, I don't hate your trade because the fact, if you noticed, the top end of your call spread is under my top end of my call that I'm selling to pay for the put spread. So that's not all bad, my friend. We can both kind of do okay in this, in the sense of I still believe, though, gold is in a range, and I still think it's going to trade lower as things kind of maybe work out with China, economic data comes in maybe a little more favorably, etc.
Last short question. Is the Fed still dovish?
They are not as dovish as they were, but yes, they are still dovish in the sense that,
Agreed.
if I may say to be kind of cute about it, they're not hawkish, that's for sure.
Amen. Thanks for joining us on Market Movers. I'm Jim Muriel, where we are helping to make you a better trader.
For more Business First AM, check us out on social media. We're on Facebook, YouTube, and Twitter. And go to businessfirstam.com for where to see our show on TV.